Welcome to our monthly Compass preview. First, we look at China. Chinese manufacturing is in for a rude awakening. Gone are the days when firms could turn out product at a loss, counting on loans and subsidies from Beijing to stay afloat. With growth slowing, China is set on cutting costs in its most inefficient industries, and steel is at the top of the list. As we've noted in previous Compass issues, Chinese steel demand has fallen, but production hasn't. In 2015, China produced 800 million metric tons of steel, more than the rest of the world combined. And to rein in producers, Beijing will centralize and consolidate the steel industry, which could chip away at a lot of wasteful capacity. But consolidation will come at a high price. It will put thousands of people out of work, particularly in some northern provinces whose economies rely heavily on steel production, and likely send them south in search of jobs. It could also stunt China's economic growth and deprive Beijing of useful tax revenue. And as for the markets, foreign competitors hoping that the new initiative will cut China's steel production and raise global prices will be disappointed. Next, we turn to India. India's economic growth rate has stalled. The promise of prosperity that brought Prime Minister Narendra Modi to power in a landslide victory has been broken. Of course, it would be unfair to blame Modi for all of India's failings. This is because India is still beset by structural problems beyond his control. See, most economies follow predictable patterns as they develop, from agrarian to low-end manufacturing to high-end manufacturing and eventually to service. India's economy inverted this process. The result is that nearly 7 decades after the country achieved independence, 50% of India's workforce remains employed in an agricultural sector that accounts for just 18% of GDP. Modi meant to boost manufacturing as part of his Make in India campaign, and in theory it would create 100 million jobs and make manufacturing account for as much as 25% of GDP. And despite some modest success, the transformation to which Modi aspires would actually require reforming the land, labor, and tax laws that currently hinder manufacturing. A tall order in a vast and fractious federalist system that represents 1 billion citizens divided by language, religion, ethnicity, and caste. So until he does this, economic growth will probably remain below 8%. Last, we visit the Middle East, where sovereign wealth funds in oil-producing countries are enormous. Established separately from the country's central banks with a simple mandate to save excess oil revenue and generate long-term returns, these funds have done just that. Roughly $3 trillion of the $7.3 trillion in such funds are sourced from oil money from the Gulf Cooperation Council. But low oil prices appear to have forced these funds to tighten their investment strategy, and asset managers worldwide are reeling from sovereign wealth fund withdrawals, which could reach $400 billion in 2016. Withdrawals are troubling news for asset managers. But in truth, low oil prices have only accelerated a process that was already well underway. Sovereign wealth funds are choosing investments that fulfill domestic needs and decrees, such as developing renewable energy, healthcare, and infrastructure projects, as well as global real estate investments with dependable returns in Europe, Russia, China, and the United States. And though GCC states also often invest heavily in developed market equities, one fact remains: not all GCC sovereign wealth funds, old or new, invest the same way. To read about exactly how they differ, check out our March issue of Compass, which publishes March 7th.